Welcome back. While Attacq has opened its books and for the half year, the firm has reported a 2.8% increase in distributable income growth per share, and it's declared an interim dividend of 30 cents per share. The financials also show that the implementation of its landmark 2.7 billion rand Waterfall City transaction resulted in the group's decreasing its gearing to 25.3% from 37.3% previously. Alongside the results release, Attacq has announced the disposal of its remaining stake in MAZ for around 773 million rand. So there's lots to talk about, and joining me to unpack this in detail is Raj Nana, CFO at Attacq. Raj, an absolute pleasure and a good afternoon to you.
Thank you.
Fantastic. Let's talk about this period in review, Raj, maybe starting from the top line and how it has worked its way down to that increase in distributable income.
Yeah, so I think you got to understand the context of the results. We're in a very high interest rate environment, and for the period we were actually, in terms of interest rates, 220 basis points higher than the prior year. So we've seen that erode earnings for a lot of real estate companies. And with that in mind, I think the 2.8% growth that we've managed to achieve, I think very good in terms of that context. I think where we've also done really well is the retail portfolio has performed, I think, ahead of expectations in terms of what retail in South Africa is in particularly doing. Our trading density growth is in double figures. Our rent to turnover ratios are sort of single digits as well. So showing that our retail shopping centers are really outperforming the rest of the market. And then combine that with the transaction that we completed with the GPF, a very, very strong balance sheet. I think we've got one of the lowest gearing levels in the industry, and really an opportune time to have a strong balance sheet when interest rates are this high, and potentially acquisition opportunities and development opportunities are now sort of arising. So I think a combination of a strong balance sheet transforming into good income from an income statement perspective, but then combining that with a really strong performance from our retail centers as well.
I'm going to actually find out about that cost environment other than interest, Raj. What else, goes into that overall expense line item that has weighed slightly heavy on earnings?
Yeah, so I think something that has been sort of plaguing the real estate sector for some time now is increases in rates and taxes, increases in utilities, from local authorities, local municipalities, and it's a bit of a double whammy in that you're paying rates and taxes and you're contributing towards these utilities, but the service delivery is somewhat lacking. So you end up paying these taxes, and then you go in addition to that, sort out these challenges on your own with sort of your private money. And unfortunately, rates and taxes as well as utilities have been increasing in the double digits, sometimes in sort of the mid-teens, which has been putting pressure on both real estate entities like ourselves, but also our tenants, where they from an affordability perspective, they can afford an all-in rental plus utilities, what we call an effort ratio, and where these utilities and rates and taxes are growing faster than their own inflation. You have a challenge where they then put pressure on the rental negotiations. So those have been particularly difficult for the industry. And what we've also seen is insurance costs have been up and considerably up since COVID. So premiums, and I think on the back of general risk in the environment with regards to social unrest, natural sort of risks around natural disasters have gone up. And as a result, being able to insure your portfolio adequately is costing significantly more over the last sort of 3 to 4 years.
Thank you for that comprehensive picture, Raj. Let's also talk about occupancy rates here and where you are seeing green shoots. Are there any places where you are seeing areas of vulnerability that could be of concern?
Yeah, so I think it is from an Attacq perspective a very good story around occupancy rates. We're up to about just under 94%. The retail portfolio effectively, close to sort of 98, 99%. But where we do have some vacancies is what we refer to as the collaboration hub, so the office portfolio, on the back of obviously a post-COVID environment where remote working is slightly more prevalent. But what we have seen, I suppose, in the last 6 months within our own collaboration hub portfolio is the utilization rates within these assets are increasing. And what do I mean by that? And so, in our portfolio, we're fortunate that we've got the likes of, big consulting firms and professional firms like PwC and like Accenture. And within those organizations, their employees are coming back to the office. And so their utilization rates are going up from 50 to 70 to 90%. And that means the need for office space is certainly there, and it's growing off the lows that what we've seen in the last 2 years. So I think that's a good sort of leading indicator on where utilization rates will inform occupancy rates in the long term. We've also seen that sort of net absorption rates in the sector as a whole. So that's new stock coming online from developments plus existing churn in existing buildings. That is actually sort of turning the other way and becoming a little bit more positive. So I think certainly early signs that occupancy rates are improving, and where we're also seeing a really great indicator is that our market rentals that we're earning within the nodes that we operate are also showing positive growth. So I think, and I don't want to speak too soon, but certainly some positive green shoots for the real estate sector as a whole.
Very, very exciting stuff. Let's talk about Waterfall now and the GEPF deal going through and what that has done for your balance sheets. Of course, we know a gearing ratio looking much better, Raj. But, on the back of that, now what?
Yeah, so we've had a few questions like that earlier today. Some investors asking for special dividends, dividend bonanzas, to say you've got the balance sheet to support it. Certainly not where we want to be allocating capital. Our long-term, obviously, aspirations is to grow our distributable income, and you do that by growing your asset base. And we're in the great position that, with the 25% gearing ratio and the development pipeline that we have in Waterfall, that includes light industrial developments for logistics, for warehousing, for data centers. We've got almost 600,000 square meters of developable space that will be coming online fairly shortly, with a water connection being secured shortly. And what does that mean? You've got the balance sheet to be able to go and build these properties, and we're certainly seeing the demand for logistics and warehousing also keep up with the sort of supply that we think we can bring online. So I think it's a great position to be in. Strong balance sheet that's also translated into a significant saving on our finance costs for this period, and it's only been included in 2 months out of the 6 months reporting period. In the next 6 months, we'll add a full 6 months out of that. So for the full year, we're going to be 8 out of the 12 months, and we're seeing some of that growth in the earnings as a result of the savings in interest come through, and hence we've signaled to the market that we've upgraded our distributable income growth guidance to between 10 and 12.5%. And again, like I said, in the context of where we are, I think a really strong indicator of Attacq's group performance.
And then let's touch on the disposal with Mass and what that means, and maybe why, Raj, you have gone in this direction at this point. Is it part of the strategic direction in which Attacq is trying to go?
Yeah, so we've been part of, or at least we've been an investor in the Mass business for the longest of times, and at the peak we held 49% of the company, and over a period of time, that declined to 24%, and then during COVID, we sold some more of that investment to shore up the local balance sheet, given the uncertainty during that time. We were left with about a 6.5% interest, and an interest sort of small enough that we lacked the sort of influence around the strategic direction of the company. We no longer had a board seat, and really we became a passive investor in what was a listed entity that is accessible to our own shareholders via the JSE. And so we were in a situation where, when Mass suspended its dividend for its own sort of liquidity considerations, it's anticipating that it would need some additional funds to refinance a bond that's coming up in 2026, and as a result wanted to retain its earnings. That decision, combined with, like I said, the fact that we didn't have an influence over the business, and we didn't really add a lot of value to it, to our shareholders, because they could access that investment themselves. We took the decision to exit, and so it was really around the timing of that exit. And in the last sort of week or so, we executed on that particular decision, and this morning the trade was booked. And so we've realized, just over 770 million rands worth of proceeds there, and as a result of that, we're going to invest it in an income-producing investment, and so net really positive for Attacq shareholders.
And before I let you go, Raj, let's look ahead to the remainder of the financial year. What are we anticipating for Attacq then?
Yeah, I think, supported by our strong occupancy rates, our low gearing levels, this additional capital that wasn't income producing for the last 6 months from mass, which we now are going to yield a return. I think we're certainly expecting a fairly strong performance in the next 6 months, and we are guiding the market, like I said, to a full year growth of almost 12.5%. So I think we're fairly optimistic about at least the next 6 months.
Brilliant. It's been an absolute pleasure hearing from you this afternoon, Raj. Thank you so much. Go well. That was Raj Nana. He's a CFO at Attacq.